Hello everyone. So today we are going to start a new chapter, and the title of this chapter is Intercompany Sales. Intercompany sales. So we are going to see from the perspective of plant asset. So last class we talked about intercompany sales in inventory. Now we are going to see the intercompany sales about plant asset. So we have two topics mainly under this chapter. One is about non-depreciable plant asset. And the second one is about depreciable plant asset. And you may have two questions from these two topics. One is about depreciable plant asset, another is about non-depreciable. Today we are here. Today we are going to see how to record some journal entries for intercompany sales that are related with non-depreciable plant assets. So here mainly who are the non-depreciable plant asset? You know that land. So land is the non-depreciable plant asset, right? So here we have some main points that we have to remember because this is quite very easy chapter. So you have to remember that parent P company sell, for example, land. Okay, land is the non-depreciable asset. So parents, or I can say here, parents company sell plant asset to S company. This is one part. In another way, S company sell plant asset to P company. So if we have this kind of sale of asset, you know that when we company sell asset, then company compare book value versus sales price, right? So whenever you sell your asset, you compare these two items, book value and the sales price. And we find gain or loss. Do you understand? When you sell your asset, you compare book value, and you know how to calculate the book value. If it is depreciable asset, it is cost minus accumulated depreciation. But at this moment, we are talking about the non-depreciable asset. So as it do not have any depreciation, so cost is the book value, right? Cost is the book value. So we are going to compare book value and sales price, and we have gain or loss. So this gain of loss is related with, because you can see that first two transactions are related with intercompany, right? Intercompany sales of asset. Clear? So if we have this kind of intercompany sales of asset, we have to calculate the gain or loss, and these loss are unrealized. These loss are called unrealized loss. It means that intercompany gain or loss. So that's why it is called unrealized. So unrealized gain or loss because it is related with intercompany. Clear? And we also know that if we have any intercompany gain or loss, we need to eliminate. So this is the first journal entry for your exam. You have to do calculation You have to do calculation to find out whether you have any unrealized intercompany gain or loss. Okay, so after find out this kind of intercompany gain or loss, which is unrealized, then we need to do one journal entry for eliminate, right? For elimination. So this is journal 1, for example. Journal. We need journal entry here. We need journal entry. So this one, that intercompany. So this is the journal entry like this. Intercompany gain or loss should be eliminated. Now, this is unrealized loss, okay? But we have something called realized. We have something called realized gain or loss. So when it is called realized gain or loss, if something like this, for example, parents company sell asset to subsidiary, right? Parents company sell asset to subsidiary, then and subsidiary S company sell asset to third party. What is the meaning of third party? That means they are not with the affiliated group. They are outsider party. So if this is the case, we have to calculate realized gain or loss. Okay. And this is the formula of calculating realized gain or loss with third party. So sales price, okay, is the sales price of the asset, sales price of assets to third party. Minus original cost of the asset within the affiliated group. Now, this is the important point to find out which one is the original cost. So go back to the previous example. P company sell asset to S company, for example, for $50,000. So here you can see that P company sell asset to subsidiary, right? So this is the sales price. This is the sales price. And I give you another information. The original cost of this asset was $30,000, for example, $30,000. So parents company sell asset to subsidiary for $50,000, and the original cost of this asset was $30,000. Now, subsidiary. Now you consider, for example, now subsidiary sell plant asset to third party. Third party for $60,000. So think up to here. Now, what is the cost of the subsidiary? We know that the cost of parent, okay? The cost of parent is $30,000, right? Then they sell it $50,000. Then S company buy this asset. S company buy this asset for $50,000 and sell this asset for $60,000. So here, for your information, the cost of S company is how much? $50,000, right? Very good. $50,000. Yes. So we see that we have several sales price, several cost price, right? several sales and cost price. But when we are going to calculate the realized, gain or loss, okay? This is the formula, realized gain or loss. The formula is sales price of asset to third party. So according to this example, what is the sales price to the third party? $60,000, right? $60,000 is the sales price to third party, minus original cost of the asset within the affiliated group. So within the affiliated group, we are going to see two costs. One cost is for P, another cost is for S, right? Now, which one is the original cost of this asset? $30,000. Yes, so $30,000 is the original cost of this asset. So original cost of this asset is $30,000. Now the profit is, realized profit is $30,000. Now this realized profit we are going to record. We record it to the consolidated. We should record it to the consolidated financial statement. And if we have any unrealized gain or loss, look at here. According to this example, what is the amount of unrealized gain or loss? According to this example, which one is called unrealized gain or loss? Because parents company sell asset to subsidiary for $50,000, right? This is the sales price, and the original cost is $30,000, right? So here we have, yes. So sales price is $50,000 minus original cost is $30,000. That means $20,000. Okay, it is intercompany. It is intercompany gain or loss, right? And it is unrealized. It is unrealized. So from this chapter, you have to calculate, sometimes you have to calculate the realized gain or loss, okay? Then you have to calculate the unrealized gain or loss. Then we know that unrealized gain or loss is called the intercompany gain or loss. Then we have to eliminate the intercompany gain or loss, right? So first point here. So first point, we find out that for journal entry, okay, for journal, the first item we already figure out that eliminate intercompany gain or loss. Okay, this is the first journal. Now we have another journal. So you have to remember that the chapter title, we are talking about the plant asset, right? Plant asset, and you know that according to your principles of accounting course, so plant asset always recorded based on the cost price. Okay, so I am the parent company and you are my subsidiary company. Okay, I sell it to you or you sell it to me, right? What is the ultimate result? Ultimate result is the asset belongs to our affiliated group. Do you understand? I have asset, I sell to you, or you have asset, you sell to me. So what is the relationship between you and me? Our relationship is we are the affiliated group. We are the parent and the brother sister company, right? For example, I am the parent and you people are the brother sister. So asset is already within the affiliated group. So as assets are within the affiliated group, when we are going to prepare our consolidated financial statement, we have to report the asset in our original cost. Okay. Although look at here, although we sell it $50,000, already we have gain, but our original cost is $30,000. So we sometimes we have to record asset debit, or sometimes we have to record asset credit to make it original form. Do you understand? So this is the second journal. Second journal is here. Return back the asset. Return back the asset value in its original cost. So this is the second journal. So when we sell our asset, it includes some profit or loss anyway. But whenever we are going to record the asset, it should become in its original shape. Okay, it should be in its original shape. That means we have to, for example, here we record subsidiary company purchased this asset for $50,000, right? This is the cost of the subsidiary company. So they will record land debit $50,000, but actually land is $30,000, right? Actually land is $30,000, but when subsidiary company record it, subsidiary record land debit $50,000. So we have to deduct another 20,000 to make it the original cost. So these are the two journal entries that you should figure out. Now we can see the question. We can see the question to explain in more detail. So here you can delete this additional journal entry. It make you confused. So delete this part, okay? Delete this part. It is something like confusing for you. Now first we are going to read the question. So do you understand which part you have to delete? I'll show you again. Delete this additional entry, okay? Delete this additional entry. Because this is not necessary for this question actually. Now read one question first, upstream sales. So here upstream sales means parent company and subsidiary company, and upstream means the subsidiary is going to sell it to the parent because parent is in the top. Okay, so upstream means sales goes from down to top. So it is called the upstream sales. Parent company owns 90% of outstanding stock of subsidiary company. So you have to remember that if it is upstream sales, immediately we have to think about NCI. But if it is downstream sales, okay, we no need to think about the NCI. Clear? Because upstream sales means profit goes from subsidiary to parent, right? But parent cannot record it 100% because they own only 90%. So you learned this from the previous chapter. So here it is important to establish NCI because it is upstream sales. On January 1st, 2021, so date is important. You have to check the date again and again. On January 1st, 2021, subsidiary company sold land. So land, again, it is non-depreciable asset. We have another part is called depreciable asset. So land is non-depreciable and it's sold to Procter company for $350,000. So we find the sales price. Now, subsidiary had originally purchased the land on June 30, 2027. So few years before they bought this land and it was their original cost. Okay, so this land is mainly subsidiary company's land, and when they buy it, it was $200,000. Now they sell it to their parent. Okay, to their parent. So these two journal. So this is not your exam question. This is not your exam question. So this journal is how they handle separately. These two journal. For subsidiary company, they sell land, they record land credit, right? They record land credit and they receive cash. I know that I told you that this cash is related to sales price, is the sales price, and this land is the book value. So we are going to compare book value and land. So they sacrifice land credit. They sacrifice $200,000, but from market, the parent company give them $350,000. And we compare sales price and book value, we find that we have a gain, we record gain. So this is the gain for subsidiary, right? This is the gain for subsidiary. Or parent company do this journal. Parent company said that land debit. Now this is their, so here book value means cost. Book value means cost of land. Cost of land. Now parent company buy this land. Okay. So this is the cost of land. Cost of land for parent company. Cost of land for parent company $350,000, and they paid cash. Cash. This is my mistake. It is 350. 350. So this is the journal entry. This is the journal entry they do, right? But this is not the because you know that the parent company, although they are parent and subsidiary, parent company will record their financial statements separately, subsidiary will record their financial statements separately, but parent company do additional statement. It is called consolidated financial statement, right? So you should know that consolidated financial statement is just separate, but both company they have their own separate financial statements. Now this is not our business for this question, because in the question we are going to see this part. So subsidiary company record gain. The subsidiary company record gain. So when we prepare the consolidated financial statement, we need to eliminate. We need to eliminate this gain. This is our first point. Can you remember? And you have to remember the second point. You have to remember the second point. Second point means we have to return back our asset, okay, in the original shape. Okay, in the original shape. Although you can see that this question we have two costs here. We have two costs. One is $200,000. Another cost we record $350,000. So now parent company record $350,000, but original is $200,000. Now we have to make it original shape, and look, this is the first journal. This is the first journal. Prepare work paper entries. So work paper entries for consolidated financial statement. And these two journal entries, these two journal entries are the parent company record separately, subsidiary company record separately. But in our question, I am not going to ask you what is the journal entry for subsidiary, what is the journal entry for parent. Okay. In your question, I will ask you work paper entries. And work paper entries are for which part? Consolidated financial statement part. So prepare work paper necessary entries because of the intercompany sale of land. So as they have intercompany transactions, okay, we have to figure out which one is the intercompany transactions and eliminate. And when we are doing this, the last day of the year. At that day, we prepared the consolidated financial statement. Clear? Now we record one item debit and another item credit. What is the purpose? To write one item debit and one item credit. So if we record gain on sale of land debit, it means that it is closed. Intercompany gain or loss closed, because usually it was credit, right? Usually it was credit. Now we recorded debit. Now this is closed. This is closed. So first part we done. First part we done here. That eliminate intercompany gain or loss. Secondly, we have to do something that will help us to record our asset or return back our asset in the original shape, right? Original shape. So look at the journal entry separately. Okay. So parents company record their this land separately. How much? Parent company record this land for $350, right? But originally it is $200,000. So you already record land debit $350,000 parent company, and who prepared the consolidated financial statement? Parent company prepared the consolidated financial statement. So parent company already record land 350, but they know that this is not the original one. So how to make it original? Now we have to credit land. Okay, we have to credit land 150. So if we credit land 150, okay, look at here, debit 350, minus credit minus $250,000, $200,000 is the original cost. So if we now record 150 credit, it becomes original check, right? It becomes original check. So the calculation, if this calculation is confused, you can see here, this one. So before we record land debit, $350,000. Okay, now land credit, 150. Now, if I ask you the balance, what is the balance? Land balance now? Land balance now is $200,000, right? Yes. So this is the journal entry that I will ask you for your exam. That prepare the work paper necessary because of intercompany sale of land. When? December 31st, 2021. Clear? Now, you should know that. You should know that. Although, so parent company, look at it. This is parent company decrease their land value, right? Parents company decrease their land value, and subsidiary company decrease their intercompany gain, right? Do you understand? But what is the problem? Although, try to understand, this is not the inventory, this is plant asset. Okay, this is plant asset, this is fixed asset, we have different treatment. So although we close our gain, okay, but this gain already transferred to retained earnings account. You know that net profit or net loss, gain or loss, we transfer where? We transfer retained earnings, right? So this is December 31st, 2021. Although we close our gain, this gain already recorded or transferred where? In the retained earnings. Now, next year, we have to close this kind of intercompany gain or loss from our retained earnings. Do you understand? This is the key point. We already close our gain, right? From which account? From subsidiary account, right? This gain closed from subsidiary and this land decreased from parents. Clear? But the gain already transferred to consolidated retained earnings. Now we have to, so the same journal, look at here, this one. We need to do the same again. We need to close our gain or loss again. We need to decrease our land again. So this journal we are going to do again, okay? But we use the retained earnings account. If it is cost method or partial equity method, so mainly cost method, look at it, mainly cost method. If it is cost method, then look, land is credit already. This land credit, look at here, this land credit, no problem, right? This is another year, next year. Try to understand, December 31st, 2022. December 31st, 2022. We are going to close our intercompany gain and loss from retained earnings. So 2021 ending retained earnings is the 2022 beginning retained earnings. Clear? So if we record beginning retained earnings debit, it means that the part of the Proctor company's gain already closed. Okay, parent company. If we record NCI debit, the part of the NCI gain already closed. So this same journal, look at this. This is same. This is same. Our purpose is same. What is our main purpose? Our main purpose to record the land in its original shape, right? To record the land in our original shape and to close the gain. But in case of gain, we know that the gain we transfer to the retained earnings, so we close retained earnings and finish. Okay, so if we do so, this purpose, this is our purpose. Don't forget our purpose. We have these two purposes: eliminate gain or loss intercompany and return back the asset to its original shape. So for gain or loss, we first eliminate from subsidiary, then we eliminate from consolidated retained earnings. Okay, if it is cost method. And if it is equity method, we know that if it is complete equity method, so according to the textbook, if it is partial equity, then you can also record beginning retained earnings. Okay. But in case of partial equity method, you can also write investment. Not big deal. Okay. Because equity method means we can we can write the investment instead of retained earnings. Okay. So it doesn't matter as it is fixed asset. And we are looking for complete equity method. So if your question is complete equity method, you cannot write retained earnings. You have to write investment. You remember in your previous chapter, right? Previous chapter. So if it is completely equity method, this is the same journal, only one accounts title different. Now same question. It is same question. That means exercise 1. I just change it. For example, this is exercise 2, for example. You can copy and paste for exercise 1. Procter company owns 90%, and it is downstream sales, yes, downstream. So Procter company owns 90%, and if it is downstream sales, you know that if it is downstream sales, we don't need any NCI. So Procter company owns 90% of the outstanding stock of subsidiary company on January 1st. P company sell land to S company. And P company had original purchased the land on June, something like this. So same question, I just convert it to the downstream, right? If we have downstream, then we don't have any NCI. So this is the first journal. If it is downstream. I copy it. Okay, this is the first journal. Whether it is upstream or downstream, the first journal is similar. Clear? You have upstream sales or downstream sales, first journal is similar because it is intercompany gain or loss. Clear? Now when the next year came, this one, yes. When the next year came, although you already closed the gain from the subsidiary account, we need to close the gain from the consolidated account, right? And we record beginning retained earnings debit, or if it is equity method, investment debit. We don't have any NCI. We close all 100% of the loss, gain. So you can see the comparison, same question, only changes here. If it is upstream, we add only non-controlling interest. If it is downstream, first journal similar, second journal or only the Procter is only Procter, no NCI. Now we can see exercise 3. This is exercise 3. So do you have any question from exercise 1 and 2? Just I convert upstream to downstream. Now again we will read the question and I will show you the main question because I have some additional calculation here. Now it is something like this. This company sell company and P company sell third party. How to handle this kind of topic? Parents companies, so subsidiary to parent, outsider, or subsidiary to parents, parents to outsider, something like this. So read the question. P company owns 90% of the outstanding common stock of S company, and on January 1st, 2000, date is important. January 1st, 2021, S company sold land to P company. So it is called the upstream, right? So we should think about NCI later on. NCI. And S company originally purchased this land for $400,000. So tell me here, up to here, you already have some calculations. So if we compare book value versus sales price, we find that book value is, this is the book value, this is the book value, and this is the sales price, right? So equal $200,000, $200,000, and you know that this is intercompany, right? Intercompany. So this is intercompany gain or loss, and need elimination. Need elimination entry. Now up to here, this is the journal entry done separately. Okay. Anyway, so I am going to show you, because parent company journal entry I already show you before. Subsidiary I also show you before. So this is the journal entry for subsidiary. And so again, I'm going to show you some calculation that not important. So this is parent company. That means I'm going to show how they record separately. Now subsidiary company record you know this calculation, right? The journal entry. Cash debit, land credit, gain credit, and parent company record land debit. And what is the cost of the land parent company? Parent company's cost is $600,000. Yes, so this is very simple, you already know. Subsidiary sell, parent company buy it. Now, whenever, because this question I didn't ask you to do the journal entry, elimination. This is elimination entry. This is the elimination entry. So this is the elimination entry, gain on sale of land debit, right? And land credit. And we have another elimination entry, if you remember our previous class. Okay, if it is cost method, then so this is year 1 and year 2. Year 2 we record here beginning retained earnings, Proctor, right? Parent P company 90%, So why I write here again, because this question I didn't ask you to do that. I ask you some more entry. NCI 10%. 10%. So yeah, this is the case. Yes, so this is the original journal entry we usually do, right? If it is cost method. So it is related with cost method. And you know the equity method anyway. This is from the first part of the question, right? Although I did not ask you, in this question, I did not ask you what is the journal entry for subsidiary, what is the journal entry for parents, what is the journal entry for elimination entry, year 1 and year 2, okay? I didn't ask you the question, but you know this is the practice. Now another transaction. On January 1st, 2022, parents company sold land purchased from S company to a company outside the affiliated group. Now here, up to here, what is the gain or loss? What is the realized? Because this is sale to third party, right? Sale to third party means we have to calculate realized gain or loss. So you have to calculate realized gain or loss. Now, what is the amount of realized gain or loss? What is the amount? So it is, what is the sales price? Look at it. Sales price is $700,000, right? Sales price to third party is $700,000. And what is the original cost? What is the original cost here? It is, I make any mistake? 200 land. Okay, yes, no mistake. 200,000. So what is the original cost of this land? Original cost of the land is $400,000. $400,000. So sales to third party $700,000 and original cost was $400,000 equal $300,000. $300,000 is the realized gain, right? Realized gain. Do you understand? Now, important point is here. So this $300,000, yes, this $300,000, this amount is actually divided into two groups. This $300,000 is divided into two groups. One is $100,000. Another is $200,000. Because look, try to understand, this is realized, right? Realized means sales with third party. Clear? Sales with third party. So we have this is sales inside the company, but look at here. When parent company, this one, when parent company sell asset to subsidiary, what is the journal? This is the journal for parent company. Look at here. This is the journal entry for parent company. When parent company sell asset to third party. So parent company received $700,000. Their cost was $600,000, right? Their cost was $600,000, and they record gain. They record gain $100,000, and this $100,000 gain related with third party. Clear? This $100,000 gain with third party, but what is the real gain? Real gain is $300,000. Why real gain is $300,000? Because original cost is not 600. Original cost is $400,000. Do you understand? Original cost is $400,000. That's why our original gain, and it is realized. And it is realized. Realized gain should be $300,000. So from this $300,000, already this one is realized gain, and we don't need any elimination. Why we don't need any elimination entry? Because this $100,000 gain with third party, right? But we have another $200,000 not yet recorded. So look at here, this 200,000 not yet recorded. This $200,000 not yet recorded, but this $100,000 already. Do you understand up to here? We have $300,000 realized gain, 100 already recorded. Why already recorded? This is the journal entry, right? This is the journal entry. All 100 already recorded, 200 not yet recorded. Okay, now how to record this 200? So look at the main question now. Actually, I explained several journal entries here. This is for increasing your understanding. But the main question is this one. Main question, calculate, try to understand. Calculate gain or loss, anyway, calculate gain or loss of the sale of land that is recognized. That is recognized on the books of P company. Do you understand? My first question, calculate gain or loss that is recognized in the book of P. And in the book of P, actually, this is the amount. This is the gain or loss. That means this calculation, this one, this $100,000 we need to calculate. We need to calculate for this. This is the answer for number one. This is the answer. This is the answer for requirement one, $100,000. Do you understand? What is the question one said? Calculate gain, right? Of land, sale of land that is recognized. Recognized. When it is called recognized, if you sell it third party. So parent company sell it to the third party. So what is the cost of the parent company? Parent company's cost is $600,000 and they sell it for $700,000. So they record gain $100,000. So this is the recognized gain for parent company. But look at the same question I asked here. Calculate gain that should be recognized in the consolidated financial statement. So when we record gain for the consolidated financial statement, we have this method. This method. Sales with third party, right? Sales with third party minus original cost, right? Minus original cost. So as this is our main method, so yeah, yes. So this is the answer for part A, that means parents company's gain, and the answer is here. So this is the consolidated gain. This is the consolidated gain, $300,000. Why? Because it is the sales with third party minus original cost. I show you the calculation here. This is the calculation of A and B. Now you can see. This is the calculation of A and this is the calculation of B. Right? But I explained some journal. This is based on question one. Okay, this is based on question one. Now look at the requirement C. After calculating the gain, realized gain for parents and consolidated, prepare work paper entries for the year ended December 31st, 2027. Now we need to do some work paper entries. We need to do some work paper entries. So here, this is the work paper entries. You know that this is the elimination. Elimination entry is the work paper entry, right? Elimination entry is the work paper entry. So I will show you some journal entries here. We eliminate our intercompany loss or gain. We make our land in the original shape, and this is for another year. Now this question, C is connected with A and B. Question C is connected with A and B. According to A, we already recognized $100,000 gain, but according to B, we calculate $300,000 gain and $200,000 not yet recorded. So this journal we need to do for C. Try to understand. This journal is for C. So this 100,000, I repeat again, don't be confused. This 100,000 already recorded, right? Then we calculate $300,000, 200,000 not yet recorded. 200,000 not yet recorded. Now question C said that prepare this work paper entries. Prepare work paper entries. Actually, this is for the remaining $200,000. Now, what is the journal? So if it is cost method, So we need to record this 200. And if you remember this journal, if you record, then gain on sale is credit, right? Gain on sale $100,000 credit. We have to do gain on sale $200,000 credit. Then it is 300. Clear? Do you understand my point? We already record gain $100,000 credit, but we have to record total 300, right? We have to record total 300. So we record gain on sale of land $200,000 credit. So when we do this, here 200, here 100. So already $300 recorded, right? Only $300 recorded. And after that, you have to remember that we eliminate gain, right? We eliminate gain on sale of land $200,000 from income statement, and this gain already transferred to where? This gain already transferred to retained earnings. Although we close it like previous example, can you remember? Although we close it here, right? We have to close it again from where? We have to close it again from our retained earnings. So these two accounts is going to now debit. So for this one, look at that. For this one, we record debit, we close it. Again, we have to close it from retained earnings, right? So when you record gain credit $200,000, then we record this two account debit. If we record this two account debit, it is completely closed. Closed from income statement, closed from the balance sheet, retained earnings. Okay, so that's why I explained some journal entry here. But although this question did not ask you to do the previous journal entry, but all are connected each other. Very difficult to remember. Okay? So you need practice. So this question, exercise 1, 2, 3 here, actually the same question, and they are connected each other. So you need to do more practice. So question 3, I repeat again, it is easy. Question 3 is easy, but I make it complicated. Why I make it complicated? Because I show you the connecting journal entries. Okay. And that's why you feel it is complicated. Actually, it is not complicated. So this is the main question. I show you several journal entries because if suddenly I do this journal entry, for example, suddenly I show you this journal entry, you will never understand what is happening, right? You will never understand. So why we record gain on sale credit? Because 100 already recorded credit. Now we have to record another 200. Clear? And if you don't know what is the 100, this is the 100 journal entry I show you. Although the question did not ask you to show it, I show you for your information. And we already eliminate intercompany gain from subsidiary account. Now we have to close intercompany gain from the consolidated. So these two is totally different, but they are connecting in one journal entry. Do you understand? They are connecting in one journal entry, but they have different concept. Now for part B is more complicated. Part B is more complicated. Why? Because it is related with depreciable property. So you already have question and solution. I try to explain in different ways with some narration. So I suggest you to read them again and again before you come to next class. Okay, so if I start now, I cannot finish it. So I suggest I will take another class later on.